there any questions from last time? Okay, so this is our last class before the exam. Next week, just a couple of notes. The exam's on Tuesday. Okay, so there'll be a proctor here. I will not be here, but one of the professors from our department here will be here to administer the exam. Same deal as last time. There'll be 4 versions. Everybody has a different one in terms of every other seat. You should not be sitting next to somebody who's got the same one, and that'll be taken care of for you. Scantron, same form in terms of the long form with 50 answers on each side. Please remember to bring a Scantron. Hour 50 minutes to do the exam. You have the entire time to do the exam, so take your time. I will be available via email from 8 to 9 a.m. through the professor. If you have any questions he can't answer, but he should be able to do everything, then he can fire me off an email and I'll be sitting in front of the computer trying to take care of business if something comes up. All right? Now on Thursday, October 30, I will not be here and we do not have class. On your syllabus, it's the second of our 2 extra credit assignments. That extra credit assignment will go live at 8 o'clock in the morning on October 30. Okay? It'll be very similar to last time. There is a video on YouTube for a film that I actually was at the premiere of and was on the panel as a discussion person after the movie was over with the director and a couple other people from the Federal Reserve. Check that out. It's a movie called Money for Nothing. But all the instructions that we need to do will go live at 8 o'clock on October 30. 5 extra points, just like the last time. The main thing is that you check it out, answer the questions, and it's real straightforward. The whole point is that you engage with something other than me. Take time out of what you otherwise would come to class to do and get some extra credit. Okay? Same deal as last time, but all that stuff will go live next week. Don't sweat it until then. The main thing you sweat right now is the material for the exam. Chapters 8 through 14 is the cover. It is a lot, is the coverage for the exam. Okay? Are there any questions on the logistics between now and October 30? Okay. Good. So, to wrap up the new material for the exam, we're going to talk about Chapter 14 today. And basically what Chapter 14 is, it's titled the Federal Reserve, but the reality of it is it's really meant to be a chapter about using or looking at central banking. Or when, I'll tell you that. Every country that has its own currency has what's called a central bank. And that central bank acts as basically the provider of the money supply. It also acts as a regulator of private banking. So in your mind, you should be thinking that almost every country in the world has basically 2 sets of banks. One set, which is called a central bank, is a single entity. Controls the money supply, regulates financial markets, and can act as what's known as the lender of last resort. Those are the 3 main functions of a central bank. The other set of banks, which are called private banks, can be anything from like commercial banks, savings banks, credit unions, depository institutions that take your money as deposits and lend out that money as we discussed last night. Okay? But those 2 entities work with each other to take new money that's being supplied and put it out into the macroeconomy as we'll discuss today. Okay? So, the idea here is that ultimately the central bank is another place where policy can move the aggregate demand curve. So, a lot of what we talked about the last couple of weeks has been dealing with fiscal policy, or when government spending, taxes, or income transfers change in such a way to move the aggregate demand curve toward full employment if we're trying to stimulate the economy, or back toward the origin if we're trying to decelerate or slow down the economy because we're trying to slow down inflation. Since 1977, Congress has provided the Federal Reserve, our central bank, with a dual mandate. Monetary policy in a macroeconomist's mind is the easiest tool to manipulate the aggregate demand curve or to manipulate the spending levels in our economy. So to control the use of that tool, Congress in 1977 said that the central bank of the United States has a dual mandate. It should both look for price stability and also ways to stimulate the economy. And that balancing act is something we're going to talk more deeply about after the exam when we start talking about labor markets and other parts of the economy in more depth. But the idea is that ultimately you're trying to control aggregate demand with monetary policy, very similar to how we try to control aggregate demand with fiscal policy, but using a completely different set of tools. So one more time, remember, Fiscal policy is much different than monetary policy, but they are related in some simple ways. Okay, but keep that distinction and that dichotomy clear in your mind. Fiscal policy has only three possibilities: change in government spending, change in taxes, change in income transfers. That has nothing to do with creating more money in the system, which are the things we're going to talk about today, or what we're going to call categorically monetary policy. Okay? Are there any questions on that just to get started? Go ahead.
I just don't really get the difference between fiscal and monetary.
Sure. So I'm going to explain more about it today, but from a sort of practical sense, monetary policy is conducted in the United States by the Federal Reserve. Okay? Fiscal policy is conducted by Congress when they decide on a budget. So just think in practical sense, that's what's happening. The decision on the budget is a decision about government spending, taxes, and income transfers. Congress decides that, and that's called fiscal policy. Monetary policy is decided by the Federal Reserve, and the things we're going to talk about today, and some of the tools that they can use to change the money supply. That's monetary policy. Okay, we will review before the end of today again. Okay? And it can be very, very tricky to remember when you're just getting started. Okay. Anybody else? Okay, cool. So these are just some core questions. What is a central bank? Basically, what government agency in each country is responsible for controlling the money supply? What policy tools are used? And how are banks and bond markets affected and involved? Okay, so those are the three things we're going to try to do here in the first part of today's class. All right. So, in the United States, the Federal Reserve System is our central bank. And that Federal Reserve System was created in 1913. So before that, the United States has kind of a wild so-called central banking history. When the United States started, right after the Constitution was passed, there was 2 failed attempts at central banks in the United States. Then for a long time, basically from the 18 teens until 1913, we really didn't have what you could call a true central bank. During the Civil War, Congress began to print currency as a national currency. In fact, until 1913, we did not have an easy way to control the national currency. Before that, there was a wild system of banking that was state-level banking. And there also was, for a long period of time in the 1800s, basically state-level currency. So if you cross the border between Ohio and Michigan, you have to basically do a currency exchange. And ostensibly, the entire economy ran on gold as an easy way to make monetary transactions. By the time we got to the early 1900s, the ability to have physical gold everywhere became more tricky, and most modern economies began to convert to some kind of a currency. Now, it just so happened in 1914, when World War I started, the so-called gold standard internationally ended, and in 1919, the world converted to a hybrid system of using gold and the British pound as basic standard currency to get all transactions done. We will talk about that stuff at the very end of the course when we talk about international finance in just a little bit of depth. But the idea is that we started this central bank because we needed more regulation on banking. We had just gone through a major financial crisis in 1907, and we wanted to get a little bit more structure into how we regulated banking in our financial markets, and we wanted more control of the money supply. So that's what happened. As a result of that, there are now 12, and there always has been, I shouldn't say there are now, there are 12 district banks. The closest one to us is in San Francisco at 101 Market Street. Okay? And then there's 11 other ones scattered throughout the United States. And very similar to the federal justice system, the San Francisco branch covers an enormous area that at one time was not as populated as it is now. Most of the Federal Reserve branch banks exist in basically east of the Mississippi River. Okay? Rationale is that when it was established, more of the population of the United States lived east of the Mississippi River. Okay? But bottom line, there are 12 branches. The headquarters is in Washington, D.C. You can go in the book and see the map of where it's all at. But what the Federal Reserve started doing initially was doing those things right there. Clearing checks. So when you wrote a check, okay, and this is not true as much as it used to be. Like 10 years ago, this changed very rapidly. Before the year 2000, if you wrote a check on your bank account, that check would have to go to the Federal Reserve to be cleared and, in a sense, verify the funds were in place. Now Visa does a lot of that work for the Federal Reserve as a private entity. Okay, so when you write a check and you're at the grocery store and you see the check get slipped in the machine, that information now goes mainly to Visa, and Visa basically confirms that the money's in your account, tells the merchant it's there, and that 2-3 second transaction clears your check. Okay, that information also goes to the Federal Reserve because they want to know how much money is in the economy. Okay, but since most of us don't write checks anymore, now if you move your debit card through, the same act takes place. So the clearing of checks should really be the clearing of monetary transactions that aren't cash. Holding bank reserves. This is one of the biggest things that have come up recently, is that the Federal Reserve acts as a place that banks can actually hold their reserve money. And since 2008 are actually being paid 1% per year to do that. So there's actually revenue for banks if they hold their money at the Federal Reserve. The reason why the central bank would want to do that is because that way they can keep a better account on the money supply. Second, it also is a way of metering how fast banks are lending. Okay, but that's also another function that the central bank does. The other one is to provide currency and also to provide loans. So on the currency side, that's the classic printing press idea of the Federal Reserve. If we need more money in the system, or we need to replace old money, and about every 12 years there's a complete washout of all the cash that was put out there 12 years ago because it's starting to lose its physical characteristics, at least in theory, and new money is printed and replacing that money. So that's not new money supply, it's replacement, but the central bank also adds money to the system, and we'll talk later about how that works mechanically. And then finally, central banks acting as the lender of last resort may also provide loans to private banks if they need a loan to clear the required reserves or to keep them from failing. So the prevention of bank failures is one of the major goals of the central bank. It's something that we'll talk about a little bit as we go on through the course, but the idea is that one of the other functions of a central bank, as I said before, is to be a lender of last resort. If no other bank is going to give you money, and you are an American bank operating in the United States, the Federal Reserve is a place where you can get a loan where no one else will give it to you, short of the Federal Reserve determining that you are going to just simply fail anyway, and then they'll find someone to buy you, or they'll just let you fail and they'll liquidate all your assets as a bank. Okay, and all that has happened historically. Okay. Are there any questions on just those simple ideas about the American central bank known as the Federal Reserve? All right, cool. This basic structure of it is that there is a board of governors, which is 12 people. What did I take it back? 7 people. Those 7 people are appointed by the president and approved by the Senate, and they can have up to 14 years in office. Okay? But there's really not a vote per se until they get to the Senate. So the current president, if there's somebody who retires, somebody passes away, or somebody just quits, the president at that time can appoint a new person to go in through that open slot. And that's 7 people. Now, why that's important is that 5 other people are added to that group of board of governors to conduct monetary policy, which we'll explain in just a minute. But each one of those board members has a 14-year overall term. There's usually 3 terms of 4 years each, and that reappointment process can only happen basically 3 times. The 14-year max allows you to replace somebody for a couple years and then have 3 terms after that. But the terms are 4 years overall. Okay? Questions? Real basic stuff. This is in the book in terms of deeper description. What I just wanted to do is let you know that this is the basic way the Federal Reserve is built. Most emerging economy central banks are built in a very similar fashion in terms of having a decision group that is appointed by a political body and then approved by another one as a check and balance. So, right now, the chairperson of that board of governors is a woman named Janet Yellen, who used to be the president of the San Francisco branch of the Federal Reserve, and is a relatively famous monetary economist on top of that. She used to be a professor at places like Columbia University, and so she is now that person. And so when you hear that there's been a speech given by the Federal Reserve, it's usually her who's giving it. Okay, so watch out for that name if you're reading the news. She runs and basically chairs what's known as the Federal Open Market Committee, and so there's additional 5 people added to the 7 governors make up the Federal Open Market Committee. That Federal Open Market Committee is ultimately responsible for monetary policy in the United States. So every month, these 12 people get together in Washington, D.C. 7 people who basically live in Washington, D.C. and go to work every day at the Federal Reserve. And then 5 other people normally made up of the presidents or some subset of the presidents of the Federal Reserve branches throughout the United States, and there's rotating seats. The New York Federal Reserve, sorry, I'm going dry up here. The New York Federal Reserve branch is one that basically has a permanent seat, and the other 4 seats rotate. Those people have to fly to D.C. every month, once a month, for a meeting of this Federal Open Market Committee. And they need to decide, should we change interest rates? Should we change some other regulation? What should we do? So financial markets watch these meetings very closely, because as interest rates change, the present value of my current portfolio choice as an investor will change. And so I'm concerned about what the Federal Reserve may do. It's also a good signal of what the stance is in terms of monetary policy, generally speaking. So right now, there's not been a change in interest rates since early 2009, when we basically got down to the bottom of what we can do with interest rates, and we've stayed there now almost 6 years. Okay, so this is a big deal in monetary theory and monetary economy circles, because this is really the longest experiment of not only keeping the interest rate at a certain level, but keeping it at the lowest possible level possible. Okay, we'll talk about that a little bit more in depth in a second. Okay, any questions on that? So let's review briefly. The central bank is a place where monetary policy takes place, regulation of financial markets takes place, and basically acts as the lender of last resort. It does hold some bank reserves and also provides loans to banks, and ostensibly as an everyday function controls the amount of currency that's in the system. In the United States, that central bank is known as the Federal Reserve, and that who determines ultimately monetary policy. And the stimulus to potentially move the aggregate demand curve in the United States is this 12-person committee called the Federal Open Market Committee. Any questions on that? Yeah?
So the federal bank is linked to monetary policy, but what do they exactly do?
I'm going to tell you, the rest of the time we have together today, other than review, is all about what they do. But that's a great question. So how do they get that done is sort of the next take. Okay? But the Federal Reserve is the controller of the money supply, and hence has the ability to manipulate the economy using the money supply in an attempt to move the aggregate demand either toward full employment or back toward the origin if there's too much inflation. Okay? So how do they do that? An outstanding segue. Okay? There are 3 main tools that a central bank can use, and I'm going to try to be very general. The book is very specific to the American example of a central bank, but whether you are the Chinese central bank, the Malaysian central bank, the South African central bank, the European central bank, or the Federal Reserve, you're basically looking at the same bullets in the gun, if you will. In other words, what can you actually do to make the economy change through monetary policy? So one thing I want to remind you of, or just say and make sure it's clear. There are 3 tools, but ultimately what's happening with each one of these tools, and we'll review this later, is that you're changing the amount of cash available in the economy, whether you are increasing it or decreasing it. These are 3 different angles on that same idea. Okay, so please keep that in mind. The ultimate end point of this is to change the money supply. There's 3 different ways of doing that in sort of a categorical sense. Okay? They are changing reserve requirements, changing interest rates, or conducting what we're going to call open market operations. Okay? How many people have seen this before in a class that you've taken in the past? Okay, if you've taken economics in high school, you should have seen a little bit of this, or at least a sprinkle of it. Okay? All right. Any questions on that? I'm going to introduce 2 additional tools later, but these are the 3 main ones that we always think about, and they're usually the 3 main ones before you go on to something that's a little more creative. Okay? So let's talk about changing reserve requirements. We talked a lot about this last time in terms of what reserve requirements mean, and ultimately what excess reserves mean. So let's review that briefly. Reserve requirements are the percentage of deposits that a private bank, a bank that has taken your money as a deposit and intends to lend it out, how much they have to hold back from lending, what they're required to put on reserve, because you might walk in and want your cash. If they've taken all the cash in and then lend it all out, and you're going to get money, it's not going to be there. So they want at least a certain amount on reserve. And right now that number is 10% in the United States. Okay? And over the last 25 years, it's dipped a little bit below 10. It's dipped a little bit above 10, or it's dipped above. It's gone a little bit above 10, but basically it's hovered around 10. All right? However, if the Federal Reserve decides that what we really want to do is either send a major signal to the economy that banks are a little bit more risky, we're going to ask them to hold more on reserve. The idea is that if I think you're lending out too much money and putting your depositors at more and more risk, I'm going to increase your reserve requirements and keep you from lending. Generally speaking, federal or central banks do not screw around with reserve requirements. They are a potential tool, but if they're moved usually very rarely and in very small increments, because in the past, when central banks have moved them quickly, one direction or the other, it's changed financial market outcomes very quickly. For example, if tomorrow we heard that the Federal Reserve is going to move reserve requirements up from 10 to 15%, you would probably see a lot of people go and pull their money out of the bank. The idea is that that's got to be a signal that the Federal Reserve sees something coming, that they're forcing banks to hold more cash and not lend as much out. You probably would see a massive sell-off in the stock market also, because interest rates would rise very quickly as a result of that, because that's a signal of more risk that maybe nobody thought of yet. So as just an emergency idea, I would want to basically cash out of those assets that might start losing value and preserve what's happened, but of course, as a self-fulfilling prophecy, if we all went to sell at one time, what happens to the price of a good or service if all of us decide to supply it for sale at one time? The price is going to want to go down. Okay? So stock market sell-offs, when the stock market falls rapidly, is because more people are selling stock than buying stock. It's just like any other market. Okay? And the reverse is true. When the stock market's going up, it means there's more demand than supply. And by increasing what you're willing to pay for a stock, it gives people an incentive to sell it to you. Same idea. Okay? Reserve requirements are a big signal, both directions. So this is also kind of a review, but let's review real quick. The idea of changing reserve requirements means you're kind of, in a sense, changing the lending capacity of a bank. So the complement of reserve requirements are so-called excess reserves. If you increase reserve requirements, you are reducing the lending capacity of a bank. If you lower reserve requirements, you are augmenting the lending capacity of the bank. Okay? So, check it out. You increase the reserve requirement, the amount of excess reserves decrease. The so-called money multiplier decreases in the sense that how many additional loans come from creating new deposits, new loans, new deposits, new loans, etc., as Chapter 13 described, will be reduced, and you're shrinking the available lending capacity. Now, what should that ultimately do to two variables that will be very interesting for us after the exam? One, what should that do to interest rates? If the reserve requirements go up and the supply of loanable funds, the lending capacity of the economy gets smaller, what should happen to rates of interest? They should go up. Why?
Because there's not as much money, so there's excess demand.
So there's less money available and that created conditions of excess demand in lending. Outstanding. That's exactly correct. Okay? So what we got to start thinking in our minds, and I'll do a little chart for this at the very end of our discussion here this morning, is that when reserve requirements go up, interest rates are going to want to go up. Okay? Interest rates are basically a reflection of the price of money. Okay? As the value of money increases, because there's less supply, rates of interest go up. That's the unfortunate opportunity cost of shrinking the money supply, or shrinking the lending capacity of the economy. Okay? What happens to GDP? If rates of interest rise, what should happen to gross domestic product in our economy and why? It should go down because what two other variables of C plus I plus G plus X minus M are also wanting to go down when rates of interest go up?
Investment and spending.
Good. Investment and consumption. If rates go up, what does that give you at home a higher incentive to do? Spend money or save it? Save it. So C wants to go down. if rates of interest go up, what happens to investment demand based on what we talked about a few days ago with respect to the investment function being inversely, or I should say, downward sloping? Do businesses want to buy more stuff if interest rates are rising and the cost of borrowing money is rising? No. So C and I are going to both go down, which will then lead to GDP falling. So there's a nice, easy logic there. If the central bank creates new lending capacity conditions that raise interest rates, GDP moves in the opposite direction, or down. If they create more lending capacity, which happens when the reserve requirement is decreased, and the reverse takes place, consumption and investment go up as interest rates fall, and GDP rises. Okay, so let me repeat that. When the central bank changes the money supply through one of these three tools in such a way that interest rates rise, they're trying to get GDP to slow down. Because what are they ultimately trying to fight in our economy? Inflation. Outstanding. If they do something to increase the lending capacity and lower interest rates, that will speed GDP up. Okay? Which is the goal there. They're trying to increase the growth rate or get us closer to full employment. Okay? Movement of interest rate, movement of GDP in opposite directions. Okay. After the exam, we'll dig deeper into that relationship, but that's something just to remember, have as a mnemonic going into the exam. Okay. Because that P will be hit on every single one of these tools. It doesn't change, and it's a very important relationship to lead this course with. Okay, in terms of your knowledge. Also, any act that the central bank does that increases interest rates is meant to lower GDP. There's an inverse relationship in terms of monetary policy between interest rates and GDP. Okay? Any act in which they lower rates of interest is meant to increase GDP. So just keep that in mind. And the variables in the middle are consumption and investment. So if rates go up, C and I go down, and GDP follows. If rates fall, C and I go up, and GDP follows. Does that help? Cool. Anybody else? Cool. Now, instead of using reserve requirements, which I said is a very rarely used and very slow-moving tool of monetary policy, the Federal Reserve or any central bank can change interest rates directly. In other words, there's a couple of interest rates that actually the Federal Reserve sets as a policy, and most central banks follow that same sort of theoretical idea that we should have a couple of interest rates as a central bank that we can manipulate on our own. I'll get to those in a little bit more depth in just a second. But the whole point is this, is that by changing those interest rates, and this is something I'll say at the very end of this section, by changing these policy rates, you are changing the opportunity cost of a bank to acquire funding. Okay? So keep that in mind. On the reserve requirement side, you are changing the lending capacity of the bank. Because you're either giving them more excess reserves in the case of reducing the reserve requirement, or you're giving them fewer excess reserves in the case of increasing the reserve requirement. When a central bank changes policy interest rates, and there are two interest rates you want to watch for, which are here at the bottom of this slide, so-called federal funds rate, or what more generally known as the interbank rate, and the so-called discount rate. And I'll break each one of those down in just a second. When I change those, I'm basically changing the cost of funds at a bank. Okay? So if I take one of those two policy rates and I move them down, that lowers the cost of gaining access to more excess reserves for a bank. In other words, it gives them a higher incentive to lend. So notice we've now connected that change back to lending again, or the so-called deposit creation. Okay. The two policy rates are, in the United States, the federal funds rate, which is how banks lend to each other. So Wells Fargo might lend money to Bank of America because Bank of America has lending opportunities that they do not want to fund out of their current reserves, and they want to borrow and engage in what's known as financial leverage instead, because the cost of those funds may be relatively low. Okay, that bank-to-bank transaction takes place at what's known as the federal funds rate in the United States. It's a special market that banks can only engage in with each other. Okay? You and I cannot get a loan at the federal funds rate. We're not a bank. If you're a bank, you can. Okay? The second rate, which is a related rate, is called the discount rate. The discount rate is when the central bank lends money to a private bank and is usually a lender of last resort loan. Okay? So bank-to-bank transactions might happen every night of the week because your bank might be getting close to its overall reserve requirement number and you're concerned about going below that number. And I don't know if I said this in here, but just as a sidebar, if you do go below that number at 5 p.m. the night before, the U.S. Marshal's Office comes and locks your doors until you clear reserve requirements because it's technically a violation of federal law. And then when you clear reserve requirements, they unlock the doors and everybody goes about their business. Banks try to avoid that phenomenon if they can. Okay? And what that means is at night, if you're dipping below your reserve requirements, you'll have to take a loan from another bank or from the Federal Reserve to get back above required reserves and that limit. Okay? Generally speaking, that's going to happen bank to bank, and that's going to happen at the federal funds rate. However, if no bank is willing to give you a loan at the federal funds rate, they're not required to do that. They're required to pay or to charge you the federal funds rate if they do, but they can refuse to give you the loan because you're too risky, and that low federal funds rate is not enough compensation to give you the money. That would then turn into a discount rate loan, and the Federal Reserve giving you that as a lender of last resort. Okay? Yes?
Does the Federal Reserve ever change rates for other banks that they can give out around times when they know people are going to take their money out, like around Christmas, let's say?
No.
They know people are going to take a lot of their money out?
That's an outstanding question. Generally speaking, the Federal Reserve has not engaged in what you can think of as seasonal policy change. No. No. It can be a very dangerous game to play in terms of how financial markets otherwise react to it. So that has not happened. What basically the Federal Reserve asks those banks to do is you need to change the way you're holding cash with the idea that more people are going to pull cash out for spending. So that's up to you as a bank, not up to us to sort of provide you with incentives. You should have your own profit incentive to take care of that business. We don't want to get involved as a central bank. That's an outstanding question. Great logic. In what sense? I'm sorry. It's another great question. The reserve requirement is set for all banks equally. Every bank faces the same proportion. So it's not, whether you have $100 million in assets or you've got $100 billion in assets, you're facing the exact same requirements because it's proportional. So if there's $100 billion in deposits, you're going to have 10% of that, or $10 billion in required reserves. If you have $100 million, you'll have $10 million in reserves. So it's just the idea that you've got the same lending capacity regardless of your size in terms of proportions to your overall deposits. Yeah, this is another great question because there's been, what does happen, which is a deeper detail that we're not going to get into today, is the deposit insurance piece does depend on your risk and how risky you are as a bank. So regardless of your size, you might be more risky than your smaller neighbor bank, and they may pay a lower cost to be insured and keep their depositors insured than you will as a bigger bank, even though you have more size. So that's how that's come into play, is how much you pay for insurance. That's a great question. Yeah?
Do banks have a fixed interest rate for lending money to the bank?
Say that again?
Do banks have a fixed interest rate for lending money to other banks?
Yes, they do. So that interest rate that when they lend money between the banks is set in what's called a target range. Right now that target range is between 0, free, and 1/4%. Usually when the Federal Reserve changes the federal funds rate, it moves that target range up by a certain percentage, but it's a range. And generally speaking, it ends up at the top of that range. So it's relatively fixed. I spoke too soon when I said yes, it is fixed. It's fixed within a range. It can't dip outside or above that range. Okay? Yes?
So when I go to the bank and I can't go to my bank, so I go to another bank and I use their ATM,
Yeah.
is that an interbank loan?
No.
Is that just you pay?
No, that's called an interchange fee. So that $3 you pay to use somebody else's ATM is a monopoly profit for choosing that bank, and you assumed you had no other choice. It's called an interchange fee, and banks rely a lot on those interchange fees for profit. So credit unions have flipped that model a little bit in the sense that what the credit union has done is they basically, as a service to you being a nonprofit organization, eliminate that fee on their side. So if you go to Wells Fargo as a credit union member, Wells Fargo will charge you for that. But Redwood Credit Union will not, for example, charge you for using their ATM if you are a credit union member at another credit union. So that inter-credit union is free. And now they're actually talking about, in the credit union industry, reducing debit interchange closer to zero as a give back to their members. In other words, picking up at Wells Fargo, which you pay to Wells Fargo, they'll reimburse you. We'll see if that holds. Go ahead and hand up. Is everybody all right? Yeah.
So what makes a bank really risky? Like the amount of loans they give out to everyone?
The amount of loans and the type of loans.
Okay. What's one of the really risky banks out there right now?
Right now, a lot of the larger banks still have a lot of risk on their books. So Bank of America, Wells Fargo, the larger banks still are relatively risky, but there's a lot of smaller banks that are just kind of treading water a little bit because they still have a lot of home loans that they can't sell that are still kind of slowly deteriorating on their books. But most banks, because the housing market has come back, have become less risky over the last few years. And the larger banks have done a lot of reallocation of assets to make themselves less risky. So there's not a lot that are out there right now that are teetering on the precipice of failure in terms of larger banks. There's still some smaller banks and credit unions that probably should fail and just get cleared out. But a lot of that's because they're still dealing with residual issues from the housing market. Good. Anybody else? Great stuff. Okay. So here's really where the rubber meets the road. The discount rate is something that the Federal Reserve and most central banks do not change outside of changing the interbank rate. In other words, they're usually moving in lockstep with each other. So if that interbank rate range from 0 to half or 1/4, 1% goes up by a 1/4 point or up to 1/4 to 1/2%, the discount rate will basically follow it. So they usually change in sync with each other. Our focus, because this is what ends up in the headlines and news, and what really banks are worried about, is the interbank rate, or what in the United States is known as the federal funds rate. So if this rate falls, other rates will fall. The reason is because the financial markets will see that if a bank has a lower cost of funding, this federal funds rate has gone down, means that if you want to lend out more money, it costs you less in interest to gain access to money. They're going to see that as a lower cost of funds, and they're going to demand a lower cost of a loan from you as a bank. And that's going to start pulling rates down across every single loan market. Okay? So the central bank knows this, and if they want to get interest rates moving down quickly, they move that rate down quickly. Now, let's see who can connect the dots. If the federal funds rate falls, what should be the steps that takes us to changes in gross domestic product? Because in late 2008 and early 2009, very early 2009, the Federal Reserve, our central bank, moved this rate down very quickly. It ended up actually going all the way down to its lower limit. It cannot go any further down than what it currently has been, basically for the last 6 years. Okay? What is the rationale behind that in terms of connecting that lower federal funds rate to a change in gross domestic product? Who's got that? Who wants to try that? Go for it. Go.
There's more incentive for investment and consumption.
Good. So there's a higher incentive for investment and consumption. If other loan rates are following that federal funds rate down, it's changing the cost of borrowing down, giving you and I at home an incentive to borrow, giving businesses an incentive to borrow to buy capital goods. Okay? And that both those acts lead to more gross domestic product. Correct. The one thing that's missing from that explanation is what happened before that. When the federal funds rate goes down and lowers a bank's cost of funds, it increases their lending capacity. So let's review that briefly. Any change in the money supply, regardless of the tool used, is meant to change the lending capacity of a bank. That lending capacity changing signals to the loan markets, we either have more money to lend or less money to lend. If there's more money to lend, rates of interest fall to provide you and businesses with an incentive to borrow, and that starts the process towards an inverse change in GDP vis-a-vis the interest rate change. I.e., if interest rates go down, GDP is meant to go up. Okay. If that rate goes up, it's meant to shrink the lending capacity, making the cost of funds more costly. Increasing interest rates, reducing incentives for consumption and investment, and lowering GDP. The opposite. Anybody have a question on that? Yes?
So when the loan capacity goes up, then that pushes aggregate demand towards the loan.
Correct. At least in theory. Okay? That's the basic theory behind how you run a central bank. Questions? Yes? I'm sorry, yeah. The question was, when you lower interest rates and increase lending capacity, are you trying to take aggregate demand and move it toward full employment? The answer is yes. When you reduce lending capacity and increase interest rates, you're trying to move aggregate demand away from full employment because your bigger concern is not where we are versus full employment, but too much inflation. Try to slow down the economy's growth and slow down inflation. Anybody else? Okay, so that's two tools of monetary policy. Changing reserve requirements and changing interbank / interest rates to try to change lending capacity. Are there any questions thus far? Okay. Now, one of the things that comes into play here is the bond market. And we haven't talked in a lot of depth about financial markets. We've talked about it in passing. But the key here is to recognize that a lot of what's happening here, because it's talking about loans, is ultimately talking about what the financial market would call bonds. Every single loan is basically a bond. So when you buy a home, you sign what's called a mortgage bond, or a mortgage. But that mortgage is a bond. It's basically a debt certificate that the bank can then go out and say, look, this person bought this house, it's paying this much rate of interest. Maybe you want to buy this for me as an asset for you to hold, and then this person's going to pay you interest. Okay? Or a business wants to borrow money to buy capital goods, and they're going to issue debt. That debt is corporate bonds or corporate debt. Okay? So bond is basically another way of thinking about debt. All right? And one way to look at that is the so-called yield is the ratio between the annual interest payment in cash, not in interest rate, but the actual dollars paid every year divided by what the bond actually is worth on the open market. Okay? Why is that important? It's important because our final major tool of monetary policy is basically trying to affect the bond market for government debt. Okay? It's trying to affect yields by changing demand or changing supply of the bonds. Okay? Are there any questions on the basic idea of a bond? So in your mind, just think a bond is the same as debt. Okay? Because it is. Okay. Well, the whole point is if you pay $1,000 for a bond that pays out $80, its yield is 8%. If that price fell to $900 because of supply and demand conditions in the bond market, that yield would change and go up to 9%, okay, or very close to it, 8.9%. Right? Why is that important? It's important because of this. The reason, why would the price of a bond fall? Maybe, but inflation transmitted into some market action. Just think real simple.
Change in interest rates?
Close. So those two are tied to each other, but that would happen as a result of this market action. Closer, maybe. Closer. Think more simple. Why do prices change in markets? Outstanding. So, if we started at $1,000 and we fell to $900, what must have happened in the market to get us down at that lower level? Either a shift of demand or a shift of supply, right? So let's look at it from the supply side briefly. If I felt like the bonds I was holding were more risky, I would want to sell them. Okay? Let's say. If I sell them, I am going to force prices to go down, which then increases the rate of interest that the bond pays. Okay? So increasing the supply of bonds increases interest rates because the bond price falls. That leads to two major ideas that we've got to keep in the back of our minds. One is that bond prices, the cost of debt on the open market, and the rate of interest that debt pays are inversely related to each other. Okay? It's a present value idea from basic finance. Right? But what that means in a little more simple sense is when the supply of debt increases, the rate that that debt's going to pay the investor goes up. What's the rationale behind that? Why should that be true? If you want to sell debt, what's the easiest way to attract an investor to you? Is pay him a higher interest rate. But the cool thing about the bond market is it technically just takes care of that for you. You supply more bonds. When you supply anything more to a market, what happens to that market's price? It goes down. If it market prices for bonds and their rates that they're paying are inversely related to each other, the rate goes up naturally. That's the great thing about the bond market. Why is that important for our purposes today? Because of this, open market operations. The final tool of monetary policy is basically the central bank manipulating the government bond market by either buying more bonds that are out there or selling more bonds that they're currently holding on their portfolio. Okay? So the central bank is usually one of the largest domestic holders of government debt. The Central Bank of the United States is a classic example of this. So the Federal Reserve has a bunch of government debt that has been issued in the past from old deficits that they bought off the market because it's relatively risk-free and easy to sell. Here's the idea. They also have a lot of cash. So open market operations are when the Federal Reserve, the central bank, manipulates the bond market to manipulate interest rates. And here's the order. There's two ways going. One, let's suppose the Federal Reserve wants to lower interest rates through this mechanism. Okay? Given the inverse relationship we just talked about, should the central bank buy more bonds to lower interest rates or sell more bonds to lower interest rates?
Buy.
They should buy. Outstanding. If they use cash and buy more bonds on the open market, specifically from banks, okay, what will happen to the bond's price? You demand more of something, what happens to the price? It goes up. In the bond market, if bond prices go up, interest rates go the same direction or opposite direction. Opposite, which means they go down. Okay? So that's the basic bond market mechanism. But what's that going to do for a bank? If I buy your bonds and give you cash, what does that increase for you? Your lending capacity. Outstanding. So the reason why interest rates in other markets follow that bond purchase is because the lending capacity of the bank is affected at the same time. So as a central bank, I print money, buy bonds from Wells Fargo. Wells Fargo now has more cash on their books. They traded me bonds for cash as a central bank, and they use that cash to increase lending. And other markets see that, just like the last two times, as a signal of lower cost of money. And rates fall and fall. Okay? The reverse is true. If the central bank has government debt and they sell that government debt to a bank, the bank gives the central bank cash, takes that lending capacity away, and reducing lending capacity means rates of interest want to go what direction? Up. But we knew that already because if the central bank is selling bonds, what do they have to offer investors to buy those bonds? Higher prices or lower prices? What's the easiest way to sell something? Raise the price or lower the price? Lower the price, and if the inverse relationship works between bond prices and rates, if I lower the prices, what happens to the rate of return that the investor gets by buying the bond from me? It goes up, and the other rates fall. Okay? When the Federal Reserve buys government bonds from the public, which is ostensibly banks, reserves increase, more loans can be made, and the money supply grows. Okay? The money supply grows because there's more lending capacity when the Federal Reserve or the central bank buys government debt from the banks. It's increasing the lending capacity. Notice that when the Federal Reserve or the central bank sells government bonds, the reverse happens. Exactly as we just described. Okay? So let me recap that. Open market operations are when a central bank uses its holdings of bonds or its holdings of cash to manipulate the government bond market. If it sells bonds, it's trying to reduce the amount of cash in the system, increase interest rates, and lower GDP. If it buys bonds, it's trying to lower interest rates by increasing lending capacity and increase GDP as a result. So there's a bunch of good mnemonics all pushed around there. Okay? Increase of money supply / lending capacity leads to lower interest rates, higher GDP. The decrease of the money supply or the lower lending capacity leads to higher interest rates and lower GDP. And I'll write all this out in a little table here at the very end. Okay? How we doing? Okay. We kind of already explained this of how you induce that purchasing behavior, so I'll just skip this, but just to remind you briefly. The whole point is that when I go out to buy bonds as a central bank, I have to pay a higher price than what is currently being offered, which is going to lower the rate of interest based on higher demand. And if I want to sell bonds, I have to offer it at a lower price, which will increase the rate of interest and generate the necessary demand on the other side. Okay. Something we've heard a lot in the paper the last few years is an idea called quantitative easing, which is when you have used up all you can do in those first 3 tools, 2 other tools are available. So quantitative easing has taken a bunch of different forms in the last 5 years in the United States. It's basically taken categorically 3 forms. And those 3 forms are basically here. One is that you're trying to manipulate other bond markets than what open market operations are meant to do. Open market operations are usually very focused on short-term government debt markets. For about 20 months, the Federal Reserve was buying long-term government debt under a sort of colloquial way of saying it, Operation Twist. And it was trying to keep long-term bond rates from going up too high. So it was demanding long-term bonds and lowering the bond yield in that same inverse relationship, but outside of the normal realm. That's known as quantitative easing. There were a bunch of government programs in 2008 and 2009 with acronyms like TALF, TARP, PPIP, things to rearrange the balance sheets of banks based on the toxicity of the debt that they held, financial toxicity. And that was also a so-called round of quantitative easing. Ultimately, those are known as selective credit arrangements for manipulating other bond markets besides the usual ones that happen with open market operations. Okay? Another tool is called moral suasion. Moral suasion is when you change the audit structure of banking and provide them with moral reasons to not be as risky. So if your business gets audited by the IRS, it's because the IRS generally sees you as a potential tax risk. When the Federal Reserve increases the audits of banks in the United States, they usually have that happening because they're trying to signal to the bank, we see you as a higher risk. Every bank in the United States gets audited every year. But when the Federal Reserve comes out for a deep audit, that means usually you might have deep problems. Okay? So the threat of that is called moral suasion. All right? But these are things outside. Changing reserve requirements, changing the interbank rate or the special funds rate, and engaging in open market operations that a central bank can do to manipulate lending capacity and ultimately the money supply. Any questions on that? These 2 do not appear in your book. Good. So to wrap up and review, to increase the money supply, you will engage in one of these 3 acts. Lower reserve requirements. Technically reduce the interbank rate. I didn't change that. The slides in the book are a little bit stuck on the idea of the discount rate, and I apologize for that. That should say reduce the federal funds rate. Okay. Or buy bonds in open market operations. Those are the 3 ways I can increase lending capacity or the money supply as a central bank based on the initial tools we discussed. Are there any questions on that? That increases the money supply. Now, what does that mean? It means we're trying to move aggregate demand to the right, toward full employment. Okay? So think about that as a direct connection. Trying to move AD to the right. If I'm decreasing the money supply, okay? These are the things I'm trying to do. Okay? Raise reserve requirements. Increase the federal funds rate, sell bonds, all that trying to move AD back toward the origin. Okay. So if you box that up, you take those 2 slides, you take a piece of paper, you put a line down the middle, and you put at the top on one of those columns, increase money supply, and you list these three things. Okay? Plus you should put AD move to the right. In the other column, you say money supply fall or money supply decrease, and you list these three things and say AD moving to the left in your notes. Okay? Have that table nailed when you walk in here in 5 days. Questions? The real deal. Monetary policy changes incentives for banks to lend or households and businesses to borrow. One of the connections we need to make to financial markets after the exam is that not only is central bank policy trying to manipulate local fund markets or the lending capacity, they're also trying to provide you and businesses with an incentive to pick up those new loans if there's an expansion. The reverse is true. If I increase lending capacity, I'm trying to reduce the incentives for banks to lend, and I'm trying to reduce your incentives to borrow. And the two should walk hand in hand. Okay? And why is that true? Because ultimately every economic act is driven by a primal idea that you and I are driven in animalistic ways to do one thing and one thing only, and that is to maximize what? Net benefits or profits or utility as the case may be. Questions? 5-minute break. Okay, any questions from before the break? Okay, so the only thing we got left to do today is review the second half of the practice midterm and gear up for next time. So let me remind you, I'm in my office today from 10 to 12, and then tomorrow from 12 to 1. Okay, and then basically, for better or for worse, I'm only available via email after 1 p.m. tomorrow until the exam, and then I'll be traveling again for better or for worse next week. Okay. So yes. Totally, 12 to 1 p.m. I'll be there from noon to 1. Okay. Stevenson 2026 and 9. Yes. Stevenson 2026 N. Okay. Come check it out. Lots of good stuff happening there, macro style. Okay. All right, cool. Let's get started. Number 1, which of the following is most likely to increase a federal budget surplus? Okay. Which one of those should increase a federal budget surplus in the sense it should be a signal that we're creating more tax revenue? B, outstanding. A higher inflation rate and a lower unemployment rate are related to what situation in the macroeconomy? Growth or recession? Growth. And of the 4 choices, B is the best answer to generate larger tax revenues. Remember, we talked about it in class. We get cyclic revenue from economic growth because as you generate more income, the government gets more in tax. So if I freeze the government spending level and growth comes naturally in the economy, I will get closer to a federal budget surplus.
But now, if we just reach full employment
Yeah.
and start going up, that's just inflation, so there's a real value or goes down.
And the real value of those taxes will also fall, but the real value of your spending will also fall.
So that wouldn't change the surplus.
Not in real terms. In nominal terms, yes. That's an outstanding question. Good. Anybody else on number 1? The answer is B. Number 2, the structural deficit represents which one of those? This is straight definition, A. Okay? When government spending exceeds taxes based on discretionary policy changes, you are creating what's called a structural fiscal deficit. Okay? In other words, you are, by choice, providing a structure for more deficit. You're choosing to spend more than you bring in taxes. Okay? California's government had this change take place in 2000 and 2001, and we're still living with it. Okay? We've been real lucky in California since 2010 that we've actually seen tax revenues rise, going toward that number. And your governor makes the claim that we actually are in budget surplus territory. But folks, there are still structural issues based on past decisions that remain. And kind of a nasty, ironic twist, part of that is based on my retirement in a system known as Calpers. Okay? Remember that acronym, Calpers. It's something that's likely to come back as part of your lives later in time. Anybody else on number 2? A is the definitional answer to that question. All right, cool. 3, interest payments on the national debt are, which one of those? What about A? Do interest payments on national debt make it easier for the government to balance its budget? So we know A is not right. Is it a redistribution of income from taxpayers to bondholders? Yes. Does the interest payment have high opportunity cost? And the answer is no, it is the opportunity cost of the debt. And is it the real burden of the debt? And the answer is no. The real burden of the debt is the shift of resources from one part of the government to the other. From the public sector to the private sector. How that reallocation of goods, we talked about this in class and it's in the book, that's the so-called real burden of the debt. Okay? Now let's take a small break here and recognize a couple things. The book kind of goes down the path that the interest payments are kind of the necessary evil of running fiscal deficits. A more in-depth look at fiscal policy would tell you that the interest payments are the immediate opportunity cost of debt, but the supposition is that, in a sense, it's not the biggest opportunity cost. Okay? So you may have looked at that and said, God, C sounds pretty close. All right? If you see this question or something close to it on the exam, that differential's been cleaned up a little bit. A little bit of a hint. Okay? But B is the best of those 4 answers. Questions on number 3. Now number 4, because I'm not very good at allocating resources sometimes, actually moves between 2 pages. Refer to figure 12.1, which is the graph we just lost above, which we'll come back to. Assuming the economy is on the production possibilities curve, crowding out suggests that the increase in government spending financed by internal borrowing would move the economy to what point, or from what point to what point? Okay, so here's the kicker. Let's break that question down into pieces. Assuming the economy is on the curve, okay, what points do that immediately eliminate? B, D, and E from the current situation at least, okay? If an increase in government spending financed by internal borrowing causes crowding out means we're moving toward the production of more public goods or more private goods. Crowding out. We've crowded out what? Because of what? We've crowded out the private sector because the government sector is getting bigger and getting more of our borrowing, or more of our lending, I'm sorry. Okay? All right, so we should be moving, of these choices, we should be moving from which one of those? Is C to A a choice we have? Yes. If we had choice F to C, the same basic phenomenon would happen. Okay? So something to notice here. Crowding out is a movement. If we're on the production possibilities frontier, crowding out is a movement away from this corner toward this corner. Okay? So if F to C was a choice, that would be good. If C to A was a choice, that would be good. Because both of those represent operating at full employment, but shifting resources from the private sector to the public through a process called crowding out that we talked about in class. So of the choices of answers, C to A is the best of those. And it's the best by how we restrict the question. We said if we're operating on the production possibilities frontier and crowding out exists, which one of those describes that phenomenon? And the point is that crowding out reallocates resources in your economy from the private sector toward the public. Okay? Any questions on that? The answer is B. Yes?
Is there any example where you could go from C to F?
There is an example where it could go from C to F in the sense that if the government got smaller and in a sense reversed the crowding out, you would go the other direction. Cool. 5. Which of those is not a characteristic of money? A. Okay? Money is not a mechanism for barter. It is in fact a replacement for barter. The other three are characteristics or functions of money. Medium of exchange, store of value, standard of value by definition. We talked about this last time. Okay? So again, that's kind of definitional, but the whole point is that we're asking not for which are a characteristic of money, but which one is not. And because money's existence and use in the economy eliminates the need for barter, A is wrong. The chair you're sitting in. The education you're receiving. If you think it's education. Outstanding question. Any other questions? One of the main functions of banks is which one of those? Why is it not lending money to savers? Who said B? Who said B? Go ahead. Who said it? Come on now. You're not going to see any of these people again in 6 weeks anyway. Go ahead, raise your hand. Who said? Outstanding. You're right. Good. It's not lending money to savers because savers don't want to borrow money, right? Savers lend money. You don't lend money to savers. Be very careful, okay? In a multiple choice exam, if you read really quickly, we know that banks lend money, right? So I see that, bang, lend money. Cool, I'm out of here, man. I'm going to go get a coffee. I'm going to go play Xbox. It's all good. I'm done here, right? Be careful not to be super speedy on that. Notice this one starts with borrowing, which I don't think banks borrow. Wait a minute, they do. They borrow from those that want to save money to then lend to those that want to borrow. And that's B. Okay? Are there any questions on that? Which one? Oh, no doubt. But the answer?
Yeah.
Totally. When you have your money in the bank, right? The bank is technically borrowing that money from you to lend to somebody else to make money, right? That's it. That's like I talked about last time. That is the primary core function of a bank. Take your deposits and lend it back out, and the difference is net interest margin or gross profit for the bank. Does that help? Awesome. What sucks is you may not be getting much of interest payments on that, even if you have it in a money market account or a savings account because rates are really low, or you have it in an interest-free checking account. Okay? But it's still technically borrowing. You're just lending it to the bank for zero. What you're getting out of it is the security and the federal insurance against it, if anything else. You don't want it home under your mattress. You want it in the bank where it's federally insured. So you're getting that rate of return out of it. Anybody else with a question on that? Yeah. Because the function of the bank is not to maintain a constant money supply. That's a function of the central bank, potentially. Great question. Okay? Yes?
This is a side note question, but how much does the FDIC insure for?
Up to $250,000 in your account per person, or should be more technical. Right now, it's $250,000 per entity, per account, per bank. For example, I can open a trust for my child, and that would be an entity that would be insured for per account, per bank. Or you and I just have our own personal checking. Okay? Used to be $100,000. Then it went up to infinity for a little while. And then it went back down to $250,000. That's where we're at. How are we doing? Questions? Concerns? Issues? Conceptual? Analytical? Theoretical? Anybody? Cool. Number 7. And your question was on number 6, right? Yeah. The banking system can lend the sum of its excess reserves in a fractional banking system because, which one of those? Is A correct? Is that true? They only have to keep a fraction of their money on reserve? Sure. Okay. But bank assets being greater than bank liabilities, there's a lot of banks out there with liabilities greater than assets that lend money, so that's not right. Reserves are a leakage from the banking system. That does not keep banks from lending money. And the money multiplier is less than 1. We know it's greater than 1, which is just dead wrong. But the main reason why we get to lend some of our excess reserves is because we have to hold some back as a fraction of our deposits called required. Anything on setup? That's known as a fractional banking system. That's how it's set up. Fractional ease is a fraction of deposits I have to hold on reserve. In most emerged economies, yes, but in some economies there are zero required reserves, but they want banks to have full freedom to lend. Great question. Number 8. Banks are generally required to keep a minimum amount of reserve because, so a related question. What do you think about that one? What's the rationale behind required reserves? We talked about it a bunch of times the last couple days. Is it because depositors might want to withdraw their money at any given time? Right, and if you're 100% lent out and you walk into the bank and the bank says, you know what, that's cool that you want to write a $1,000 check, man, but I ain't got the cash right now. My bad, ain't gonna happen. First thing I do is say, okay, great, give me a check for the entire shoot match ASAP, because I'm leaving, I'm done here. Doesn't make any sense. Required reserves are a buffer against the banks want to lend out at profit and their customer service for their depositors and having cash on demand at all times. Who had a hand up? I thought somebody said, no questions, really? Yeah.
Theoretical question.
Sure.
Everybody came and withdrew their funds, then they would have to take out a loan.
Correct, technically. Furthermore, if everybody came in and draw out their funding, it would reduce the lending capacity of the bank and put the bank in big trouble. That's called a bank run. So a run on a bank is when a single bank has a lot of its depositors come at one time, get in a line to start pulling all their money out of the bank because they believe the bank is too risky. Federal deposit insurance, given by the so-called FDIC, is meant to avoid that problem. That, you know, even if the bank sounds like it's getting a little teetery in terms of risk, we've got you back. Or technically the taxpayers do. Okay? Cool. Number 9. Holding everything else constant, the money supply gets smaller when which one of those happens? So if the Federal Reserve reduces the reserve requirement, does that make the money supply get smaller or bigger? Okay, so that's cool, that's good. So C is eliminated because of that. If banks lend money, does that make the money supply smaller or bigger? If I lend to you, what does that create more of? Money in system, deposits? Or we talked about that. We're trying to increase lending capacity. The bank decides to lend you money, increase capacity. So that is when it gets bigger. An individual deposits money. Deposits is deposit creation and lending capacity creation. So B is not correct. The answer is A. When a loan is repaid by a bank customer, it technically shrinks the money supply. Okay? Because the number of total loans has gotten smaller. Okay? And really, A is correct technically, and B, C, and D are by definition wrong. Okay? The money supply will grow even larger through deposit or loan creation when which one of those happens? What about A? People decide to use cash instead of checks. Does that matter? Because it's still cash. Banks stop making new loans because they're too risky. If they stop making loans, does that make the money supply grow larger or smaller? Smaller. So C can't be right. If interest rates rise, does that make the money supply get bigger or smaller? Smaller. Okay? So the answer should be B. If consumers, businesses, and government increase their borrowing, what will the bank do to provide them with that or provide that demand? They will lend more, which then increases the money supply because it increases the overall lending capacity. Okay? So B is the correct answer to 10. Okay, so let's take a small, like 30-second break and recap on these ideas that we learned today and are now reviewing. Okay? The money supply gets bigger when the lending capacity of the economy grows. As the lending capacity of the economy grows, interest rates fall, provide the necessary incentives on the demand side to basically clear the market or demand the new increase in supply. The reverse is true. If there is a reduction in the lending capacity, interest rates will rise to reduce your incentive to borrow, and make sure that there's not an excess demand anymore in the system. Okay? They're walking parallel lines in theory. Any questions on that in terms of the money supply changing? All right, cool. 11. The line described by the consumption function, which in class we talked about as this sort of linear function with a slope and an intercept. So consumption is equal to autonomous consumption A plus B. What did we call B? More technically. The MPC, or the marginal propensity to consume. If YD, disposable income, goes up by $1, some percentage of that new dollar of income will be consumed. That's called the MPC, or is the slope, or the rise over the run of the so-called consumption function. Okay? That means its slope will change, or number B will change, with y equals mx plus b slash the equation of a line, when which one of those four choices change? But which one? A, by definition. But let's take that question to another level, because you might see this in a little different way on Tuesday. The slope changes when the MPC changes, because the slope and the MPC in this line are one and the same. Okay, so that was more definitional. But what would shift the entire consumption function of those choices? What would move it? A change in not B, but A. So which one of those four choices would lead to that outcome? We talked about this in class. Something that would shift the entire consumption function would be a change in which one of those? Disposable income is actually a movement along the curve because it's part of the function. But that's good. I'm glad you said that, because it might be a little deceiving. But we're talking about an entire shift of our consumption at every level of income. Which one of those four represents what would happen if there was a change, or if I expected a change in consumption regardless of income? Your what has changed? Your confidence. Consumer confidence is something that will shift letter A in that consumption function, because it will give you an incentive, because you're more confident about the future, to increase your consumption at all income levels. Okay? Check that out in the book and in your notes. We talked about that in class. Questions? It would be worded, so instead of saying the line described by the consumption function will change its slope when X, it would be the line described by the consumption function will shift to another position when X. Okay? Awesome. If the investment demand curve shifts to the left, so let's just stop right there and think about this for a minute. The investment demand curve is a downward sloping function that connects interest rates and how much businesses want to buy in terms of productive capital. If it's shifting to the left, right? Correct? Sorry. If it's shifting to the left, it's moving toward the origin, just like any other demand curve. Okay? So think about that. Which one of those would happen if investment demand moved toward the origin or fell at all interest rates? It would be A. The reason is because the investment demand function is representative of capital I in C plus I plus G plus X minus M. So if it's moving down and reducing at all levels, aggregate demand should fall and follow. Same movement. The entire point behind that question is that investment will shift the aggregate demand curve if it changes. If investment goes up, aggregate demand moves toward full employment. If investment goes down, aggregate demand moves toward the origin. Okay? That's the point behind that question. Concerns or issues? Yeah?
Quick question about the investment curve.
Yeah.
As interest rates go down, their willingness to invest goes up, so that's why it's
Downward sloping. And the rationale behind that is the opportunity cost of buying more productive capital is falling as the interest rates fall, and you have an incentive to increase, just like in any other market. The price is falling, incentive to consume rises. Inverse basic law of demand. 13. Which of the following fiscal policies would cause an increase in aggregate expenditures, or the total amount of expenditures or aggregate demand in the economy? Which one? decrease. Anybody?
It's D.
Why?
Because, well, naturally, if the taxes go up, your expenditures would decrease, or, well, expend less, basically.
Okay, so an increase in taxes is the first trigger. The reason why you chose D is because a decrease in government spending has basically the same outcome, right? So if you're doing both and each, that's guaranteed. Let's walk up the other three and break it down. If there's an increase in transfer payments and an increase in government spending, is that going to decrease aggregate expenditures or increase them? If we're increasing spending, what happens to expenditures? They go up. We're asking what happens when we have a decrease, so A can't be right. B, an increase in transfer payments and a decrease in taxes. If we do both of those things, what happens? Are we increasing spending or decreasing spending? I increased transfer payments, gave you more income, and I lowered your taxes. Am I trying to lower your expenditures or increase them? Increase them, and we're asking for things that decrease them, so B's not correct. C, a decrease in taxes and an increase in government spending. If I decrease your taxes, am I trying to get you to spend more money or less money? More, so we're done immediately. And D has to be it, either by elimination or by definition, and it happens to be both. Guess what? Increase in taxes, lower spending. Decrease in government spending, lower spending. In sum, lower spending, and that's exactly what we asked for. A corollary issue here, notice that we're talking about things like transfer payments, government spending, taxes. We asked about the following fiscal policies. Nothing to do with monetary policy here. This is all about fiscal in this question. Connect those dots. Okay? I didn't talk here about the money supply changing because it's got nothing to do with fiscal policy. You know what I'm saying? How are we doing? Anybody? Y'all good? Go ahead.
For D, I still don't get why we're increasing taxes for us.
On B?
For 13.
For 13B?
Yeah, no, 13, D.
So 13D, if I increase how much you're paying in taxes, how much you're going to be able to spend? More or less?
Or less, sorry.
Totally. It's going to be less. And if I decrease the amount the government is spending like a consumer, what's going to happen to macro spending levels? So if you add the two together, spending should go down. That's the only combination of the four that gives you guaranteed lower spending. Are we cool? Anybody else? 14. The opportunity cost of the national debt is which one of those? When the economy loses income due to increased government interest payments. Okay? Is that true? Did you say B or D? B. Okay? Correct. Okay? It's basically related to the question we saw before. And folks, this is a quick sidebar. There'll be 40 questions on the exam. The sum of the two practice tests, I've asked you 44 questions. Okay, so some subset of those topics is going to show up on the actual exam. Okay, the exam is written, the exam is copied, and is ready to go already. Okay? So just keep that in mind. 40 questions. So only 40 of these 44 topics are going to show up, so you're good to know them all. But we're not going to go outside that range. Okay, as discussed. 15. Which of the following would cause the money supply to decrease? Now let's stop there for a minute. Now we're talking not about fiscal policy, but monetary policy. So if the money supply is going to decrease, which one of those holds true? Is borrowing more a way of getting the money supply to decrease? A is wrong. B, the economy emerges from recession into rapid growth. If you're growing in the economy, are you demanding more loans or reducing your demand for loans? You're increasing it, so it should increase the money supply. Society moves to a cashless society. Shouldn't matter. In the sense that if you go from using cash to using something that's equivalent to cash, it's using the same amount of money that's already out there. And if banks make fewer loans, when banks reduce their lending capacity, does the money supply decrease? D is the answer. Questions? in figure 8.5, if this economy's inflation goal is price level P2, okay, right there, but the equilibrium price level is P3, meaning we're starting right here, an appropriate monetary policy would be to do what? Okay, let's have a look. But before we do that, how do I get from P3 to P2 if I'm trying to use monetary policy to get there? Which one of those curves need to shift and what direction? Want aggregate demand to go toward the origin. We're starting at P3, the top price, and we want to end up here. So we'd like AD2, because the current equilibrium is AD2 and AS2 by the nature of the equilibrium price level currently being P3, this one right here. So we want AD to contract or move toward the origin. What do we need to happen to the money supply for the aggregate demand curve to move back toward the origin? Do we need the money supply to increase or the money supply to decrease? To decrease. So let's see what choices we have. Decrease aggregate supply. Well, we know aggregate supply decreasing is not going to get us from point P3 to P2, so A can't be right.
Just eliminate ASD.
Correct, for the same idea. Because we know from before when we just explained that aggregate demand is what's going to move us from P3 to P2, so a movement of aggregate supply ain't going to get us there. So AS moving is incorrect, so A and D are gone immediately. That leaves us with either increasing interest rates or increasing income taxes. Which one is monetary policy? The change in the interest rates. We saw a very similar question in the last review, in the last, or part one of our practice exam, about fiscal policy. If we were engaged in fiscal policy instead of monetary policy, which one of those choices would be correct? C. Okay? So what's nasty about the dichotomy between fiscal and monetary policy is they have the same effects on aggregate demand. When the money supply increases, it moves aggregate demand toward full employment. When fiscal policy is expansionary, it moves aggregate demand toward full employment. But they're happening for two completely different reasons in two completely different places. Be careful. 17. Monetary policy involves the use of money and credit controls to do which one of those? This is a tough one, because we just answered this. Are we trying to move along the aggregate demand curve and the aggregate supply curve, or are we trying to shift the aggregate demand or aggregate supply curve, and which one is it? Shift the demand curve. Outstanding. We just answered this question. Okay, so the hope was that you would go from the answer of 16 to 17 real easy. And monetary policy set by which one of those by definition? We talked about this today. Be careful. Because you might think it's the Board of Governors. It's not. It's the larger board, which is known as the Federal Open Market Committee. Outstanding. Okay? Questions or concerns? The answers to the two practice midterms are up, and in fact, at the very bottom of this sheet, as you can see here, they're all there online. Okay? I have cleaned up some of the language on the first midterm, or practice midterm. So check that out. There's new files up on the web. But before you leave, okay, I want to move very quickly through our essay answers. Some of you may want to have some guidance on those. Okay. I gave you 6 possible essay questions. Okay? So now let's briefly go through the answers of each one of those. What's that? There's going to be 2. So remind yourself, it's going to be the exact same structure as last time. 40 multiple choice, 2 essay. Okay? 2 points each on the multiple choice and 10 points each on the essay questions. This is, I tried to jam this all in, but here's the bottom line. The answer to the first question, which says draw an AS-AD equilibrium showing all 3 sections of the aggregate supply curve and then describe why each section is shaped the way it is briefly. Okay? 2 things happening here. I need to see, well, actually 3. I need to see 3 things. 1, I need to see that you drew this graph correctly and labeled it correctly. 2, I need to see that you actually showed me equilibrium because I asked for equilibrium. And 3rd, I need to see your descriptions. So what I did to answer this question, which is a full credit answer, labeled correctly. Okay? Notice I also labeled that where full employment existed, based on the vertical portion of the aggregate supply curve, which technically is vertical, excuse me for the wiggle there. And notice I defined that there's 3 sections of this curve, 1, 2, and 3. And then over here, section 1 is flat. Okay? No inflation expected. In the flat portion of the aggregate supply curve, you can grow without the expectation of inflation. Then, as you grow larger and larger, you'll end up in number 2, where you're getting growth with inflation, and that's the upward sloping portion of the curve. GDP rises and prices rise with each other. At some point, you then get to full employment, at which if you grow even beyond that, if you grow at all beyond that point, you are generating only price increases. Okay? So that describes the 3 sections of the curve, equilibrium, and the structure by labeling the graph correctly. Are there any questions on that? Yes?
Can you explain the number 2?
Yeah, the upward sloping, my attempt here to draw, write the letter P got a little bungled.
Oh.
But that means prices. Sorry about that. Yes?
On 1 it says flat, and 1 it says under.
No inflation. It should have been P with a dot over it. Okay, so the time change in prices, or P with a dot over it, is inflation for us. Okay? Anybody else? Number 2. Describe why the investment demand curve is downward sloping and that what the price or opportunity cost is of a business increasing its current inventories by buying new and productive capital or building new homes. All right? Whole idea here is the following. In terms of capital I in C plus I plus G plus X minus M, that level of investment is determined in the framework of a macroeconomist by where the interest rate is. And that R super E is the expected nominal interest rate. So if those interest rates begin to fall, investment demand will rise. If interest rates rise, investment demand will contract. Why? Because the interest rate is the opportunity cost or the price of purchasing new productive capital. Okay? So the law of demand holds between those 2 variables. Okay? That's the idea. Downward sloping function, fully labeled, with a simple explanation that the interest rate acts as the opportunity cost. Yes? R super E means the expected nominal interest rate, which means it is the real interest rate plus expected inflation. Okay? We talked about that in class. Anybody else? Explain the difference between adaptive and rational expectations briefly. A way of doing that is to provide me basically with a table that says this is how you describe adaptive and this is how you describe rational. Now looking at this again, it's a little more sloppy than I had hoped. Apologize. In adaptive, we assume that information is not equal between market participants. In rational, we assume that it is. You and I have the same information set, so we should know exactly what the other person's going to do and come to a rational outcome. In adaptive, one of us has more information than the other, and we can profit off that information differential. Second, in the adaptive world, we are reacting to new information as if it is the only information available. In the rational world, we take new information and synthesize it vis-a-vis what we already know, or the history of the information about that topic. Okay? One of the problems with not having all the information is I can't synthesize new information as part of an entire set of information because I don't have that entire set. So any information differential can lead to profit for the person that has more information. And as you go on and go, if you're going to be a finance major or an econ major, you will find out the importance of information the more and more your education progresses, in terms of information in financial markets. Sorry about that. Finally, adaptive expectations happens when we're not at full employment. In other words, the reason we're not at full employment is because one side of the labor market has more information than the other. Rational expectations suggest we've closed that gap. Workers and firms have the same information set, and rationally, as if by an invisible hand, come together to equilibrium, and the market's clear. Yes? Reacting to, well, that looks worse than now that I'm saying it again. Sorry about that. Reacting to new information. Thank you for saying that. Good. Question? Awesome. This is all review, right? You should not be hearing any new information today. This is an easy one. Definition of money by 4 characteristics. Now, what I did originally is I thought when I put this test up, I was going to talk about the 4th characteristic, which is this one here, a standard of debt in more depth. But basically, the standard of value, meaning that all goods and services are priced in terms of what you're calling money, has a sister function, which is you're pricing all debts or what people owe in terms of that money as well. So the 4 functions or characteristics are medium of exchange, store of value, standard of value, and standard of debt, or what might otherwise be known as standard of deferred payment. Okay? This is straight definition. We talked about it last time. Are there any questions? Awesome. Number 5, and I want to take a little bit of time on this one. Leakages versus injections. So explain the leakages and injections equality and what constitutes a leakage and what constitutes injections. Okay? So you may remember that we came to that bottom equation because of the equilibrium conditions for the macroeconomy, GDP equals C plus I plus G plus X minus M, and for the household, that GDP is equal to consumption plus savings plus taxes. In other words, if I took taxes away on both sides, I'd be left with disposable income is equal to consumption and savings. Okay? If I am in equilibrium, both those things are equal at the same time, which means I should be able to take one and equate it to the other to see a much broader way of representing equilibrium in the macroeconomy, and that's exactly what this bottom equation suggests. When the leakages, savings, taxes, and imports increase, our ability to consume domestic goods, consumption, letter C, falls because income is falling. If I plus G plus X, the injections into the economy increase, income rises, and our ability to consume domestic goods, letter C, also gets bigger through the consumption function. Okay? It's important you know that. Okay? For me. Okay? It's more important to know later in sense of the policy aspects of manipulating that equation, because that's where we're ultimately going, especially when we get into international trade and finance at the end of the class. But it's important now too. Any questions on that one? Yeah. Of course. To answer the question, the left-hand side of this equality represents the leakages. The right-hand side represents the injections. If the leakages rise, income falls and consumption falls. If injections rise in their value, income rises and consumption rises. Okay? The point of the equality is we should always expect there to be movements toward equilibrium. So if the right-hand side increases initially, the income change will generate a reason for the left-hand side to increase to match, and vice versa. Questions? Whoa. Sure.
Do we have to derive it, or can we just go straight to S plus 2 plus that?
You might have to derive it. But it's really my sincere hope, since we've seen this 3 times in class, that the derivation should not be a struggle for you. Okay? If you you remember the two equations and you remember simple algebra, you should get home. Okay? Not saying all y'all will, but that's the idea. Questions? Yes?
So where it says C plus S plus T equals C plus I plus G plus X minus N, what is the little?
EQ, or equilibrium. That's another way of representing macroeconomic equilibrium. Thank you for asking that. Finally, open market operations. Explain how they stimulate the economy when the central bank purchases government debt from private banks. Open market operations are stimulative in the economy if you are buying bonds as a central bank, right? Because by buying bonds, what is happening to the money supply? It's going up. The money supply goes up, the cash provided to banks for their bonds increases. In other words, if you're providing cash, there's excess reserves, which increases the loanable fund supply, which lowers rates of interest, increases investment, and increases GDP. Notice the inverse relationship between interest rates and GDP flows through investment demand, linking this question to this question. Repeat. The nature of the mechanics of monetary policy and the inverse relationship between interest rates and GDP once money supply changes links the ideas of monetary policy to the ideas of a downward sloping investment demand function. In other words, monetary policy presumes that its effects on the banks will transmit themselves through the business decisions to buy more goods and services or ultimately more productive capital to increase GDP. Okay? Those are natural links that we will talk about as the class moves forward. Any questions on number 6? And we just kind of talked about this issue at length today. Office hours today from 10 to 12. Tomorrow 12 to 1. Via email otherwise. Yes? 2. Same structure as the last test. Vaya con Dios.